Assalamu alaikum and welcome to another episode of Wealth with Wahed. This is episode 2 from our special series with HSBC on ESG investing. I'm your host Adam, and today again we're joined by our special guest Sefian Kasem, Head of ETF and Indexing Investment Specialist at HSBC. Welcome again, Sefian.
It's great to be back, Adam. Nice to see you again.
So in the first episode, we talked about the fund in itself and how ESG would benefit investors looking into deploying their funds. In this episode, let's touch base a little bit in terms of who would this be most appropriate for. So perhaps the first question that I would put forward to you, if you don't mind, is what are the financial goals for investors when they look at investing in these funds?
Sure, that's a great question to start with. So I think this particular fund is relevant for investors that want to invest for the medium to long term. They're looking to grow their capital in a steady manner over time. That's the purpose of investing in passive funds. They give you broad-based diversified exposure to a specific theme or asset class, and they enable you to grow your capital over time on the basis of a specific risk-return profile that you may have in mind. So different asset classes have different risk-return profiles. So this type of fund will enable investors to preserve and grow their capital in an understandable fashion.
So you would say capital preservation as well as capital accumulation for this fund in itself?
Absolutely.
So what about those clients who are more keen in terms of generating income for their portfolios?
I think those types of investors are better off looking at fixed income type funds. So, for example, a Sukuk fund, a passive Sukuk tracker would be a great way of investing money in a way that gives them a constant income stream over time.
That's great. Let's shift a little bit in terms of the financial goals. Let's look at the risk profiles of this client. What would you say the appetite should be for an investor who's looking to invest in this type of funds?
I'd say this type of fund is probably at the more risk-loving end of the spectrum, if you like. It's an emerging market product, and emerging markets typically have a little more risk associated with them than developed markets. So I think for investors that have more of a risk appetite, this particular fund would be great for them. But again, I'd emphasize that we're talking about a passive tracker fund here, so it tracks an underlying index. So it's a bit different to an active fund where the fund manager may be taking significant risk versus a benchmark. This simply tracks an emerging market benchmark, so it's not quite as risky, if you like, as an active fund.
All right. Okay. That's great to hear. You've mentioned a little bit about underlying index. Would you be able to talk about the asset class and some of the actual names or the sector breakdowns about this fund in itself?
Sure. So as mentioned, it's a construct which gives investors broad-based exposure to emerging markets. So there's a whole range of emerging market countries which are covered by this product. So it has a range of different exposures. I would say from a country standpoint, it's probably skewed towards Asia. So some of the largest constituents are Asia focused, so South Korea, India, mainland China, as you would expect. They're some of the biggest equity markets in the world. From a sector standpoint, it's skewed towards technology. We've seen a lot of growth in the technology space, technology stocks globally, in particular in mainland China, over the past few years. So there's a slight bias towards the tech sector in that respect.
Wow. That's quite the exposure that we have from this underlying fund. So finally, I think maybe some of the clients would be interested in understanding how expensive would this be to have all these different exposures in terms of your portfolio in itself. So could you elaborate slightly in terms of how much it would cost to run the fund in itself?
Absolutely. So passive products generally are much, much cheaper than their active counterparts. They're designed to be very cost effective. And this particular fund, I would say, is also pretty cost effective in the sense of the expense ratio, the total expense ratio associated with this fund is 0.3%. So investors can invest in emerging market equities, broadly get broad diversified exposure, grow their capital, as mentioned previously, at a steady state over time at relatively low cost.
All right. Okay, so maybe if I can just summarize everything to make sure that we have everything all together. the fund in itself is catered towards clients with the financial goals of growing and accumulating their wealth, and they would have to have a little bit more appetite towards risk. So they naturally be a little bit more aggressive investors, and it looks at investing in the emerging market sectors where a lot of it is under the equity side. Some of the countries that you've mentioned is India, South Korea, as well as mainland China, and the cost of the fund in itself is actually quite affordable and cheap.
Absolutely. Spot on.
Okay, great. Thank you so much, Sefian, again. Actually, there are a lot more that we can talk about today, and we still have a couple more episodes to talk about ESG. I hope you found this episode relatively informative, and we can continue to tune in into our subsequent episode in conclusion. Thank you once again, everyone, for tuning in. Remember to subscribe to our podcast for future episodes, and be sure to follow us on our social media using the hashtag Wahed Wealth. Until next time, happy investing, and thank you, Sefian.
Thank you.